What is up, YouTube? I'm Adam Odell, Chief Investment Strategist of moneyandmarkets.com and founder and co-editor of Green Zone Fortunes. This week, I am not joined by my research analyst, Matt Clark. He will be back next week. He's taking a full week off of vacation, that lucky guy. I'll let him tell you next week if he chooses to, where he went and why. So it's just me this week. So welcome to the first week of July. Happy 4th of July. I hope you have I hope you had a nice, good long weekend. And so we're going to jump into a couple user questions today. We got some questions from YouTube. Last week, I covered Enphase, a solar company that, in my opinion, is overvalued. It's already had a monster run. So if you're just now getting into it, I would look elsewhere. We did have some folks write in that they've made 505% on Enphase and that 50% of their investments are in solar. So certainly a lot of people are in on this trend, and congrats to everyone who made big money in that trade. All I'm saying is that Enphase at this point is not an attractive valuation. So the first question we're going to get into, again, comes from last week's YouTube video. It comes from Dove10565, and this person asks, just curious, why not CSIQ? It's similar growth, but much better valuation. So the CSIQ, that's the ticker symbol for Canadian Solar. So ironically enough, Canadian Solar is a company that we've recommended in Green Zone Fortunes. It's currently one of our portfolio holdings. I recommended buying shares of Canadian Solar last July of 2020 for around $23 a share. We basically enjoyed a nice run up from $23 a share to over $50. It kind of peaked out around $60, $65 earlier this year. We've taken half profits on half that position of about 120%, and we're holding the second half of that position for about an 84% open gain as of right now. So it's interesting that this person mentions the valuation last July when I recommended shares of Canadian Solar. I called it the absolute cheapest solar stock you could find. And I did some industry comparisons, and on a number of metrics, it was very, very cheap. So I wasn't really surprised to see that run up of over 100%. That was largely on multiple expansion. When you buy a stock for a very low multiple, all that really has to happen is you have to have other investors realize that's a low multiple and bid the stock higher. That's called multiple expansion. The earnings don't necessarily have to change. And that's certainly what happened with Canadian Solar. So interestingly enough, Canadian Solar is not anywhere near as cheap as it was last July, but it is still very cheap relative to Enphase. So just some of these metrics, Enphase has a price to earnings ratio of nearly 297, price to sales ratio of 31, and a price to book ratio of 36. These are all very rich valuation numbers. In comparison, Canadian Solar has a price to earnings ratio of 45, a price to sales of 0.8, which is astronomically cheap, and a price to book of 1.9, which for a solar growth company is very, very cheap. So I'm still very bullish on Canadian Solar. If you'd like my full write-up on Canadian Solar, all you need to do is sign up for Green Zone Fortunes, and you'll get immediate access to that. I also put out a weekly video for my Green Zone Fortunes subscribers. It goes out every Wednesday, and we break down the growth prospects of one of the portfolio holdings each week. And this coming week, I will be covering Canadian Solar because they actually have a carve-out equity IPO planned for the latter half of this year in China. So I'm going to be speaking about that. So still a ton of opportunity in Canadian Solar. For me, it's definitely a buy. And if you want all the details, just sign up for Green Zone Fortunes, and you can take a look at that. So the second question we got from last week's YouTube video as well is from KD Investing, who says, I'm mostly interested in commodity stocks, particularly precious metals. What do you think about BTG and MTA? This person also asks about uranium stock picks. I'll leave that for another week. But as far as precious metals, and we'll call them gold miner stocks, I am long-term bullish on precious metals. I started seeing the bottom form between 2015 and 2018. We got a couple of breakouts, bullish breakouts of that bottoming pattern, one in 2019, again in 2020. We got a retest of that breakout pattern in 2020, basically during the COVID crisis, because everything sold off during the COVID crisis, even precious metals, which are typically hedges during crises. But there was basically a liquidity cascade where everyone was selling. They were even selling good assets to fund margin calls on bad assets. So it's kind of a situation to throw the baby out with the bathwater, so to speak. But we saw gold and gold stocks come roaring back out of the recovery faster than almost anything. So that was a good retest of that breakout level. We got a good rally in gold for a while, but it's certainly pulled back this year in 2021 as folks have looked at other parts of the market. Certainly Bitcoin, I believe, has drawn a lot of people that are looking for something, a hedge out of the stock market, something anti-fiat, so to speak. So I think a lot of people have been, maybe would have invested in gold or invested in Bitcoin, but we'll see how that goes. Bitcoin certainly had a rough slog here recently. But back to precious metals, I think that commodities in general are a long-term boom and bust play. They boom and they bust. And so right now, gold has had a tough time. It peaked in 2011. As I mentioned, it was in a long-term bottoming pattern from 2015 to 2019. And we're just now seeing the early signs we've seen the first phase of that breakout. But I think some folks have kind of thrown in the towel and thought, well, maybe this is it. Gold is still trading above its breakout level. It's certainly had a pullback. So I think it's a good time to get in, but it's certainly it's not an obvious trade right now because most people aren't looking at the long term. But I think that we have a 5 to 7 year bull run in precious metals. That's gold, that's silver, that's platinum, as well as the industrial metals as well. I mean, if you think about the growth of the electric vehicle market, you've got a number of those industrial metals that are going to be in high demand as well. So I'm certainly, like Katie, investing long-term bullish on commodities in general and precious metals specifically. So let's dig into these two companies, ticker symbols BTG and MTA. I've pulled up a couple of my pages here. So first of all, BTG, this is B2 Gold Corporation. This is a Canada domiciled company, $4.4 billion in market cap. Just some of the key metrics I'm looking at: a price to earnings ratio of 6.8, super cheap; price to book of 1.7, very cheap; price to sales of 2.5, very cheap. As far as margins, they sport a 69% gross profit margin and a 36.5% net profit margin. That is very, very fat. As far as the balance sheet, they've got about $500 million in cash on the books and just 20% of that in debt. So about $100 million in debt, $500 million in cash. Their operating cash flow is nearly $1 billion on sales of $1.7 billion. So all in all, this is a solid looking company based on these metrics. They pay a forward dividend yield of 3.8%, which is certainly more than you're going to get in treasury bonds or T-bills. Obviously, it's not an apples to apples comparison because we're talking about a gold mining stock. There's going to be more beta and more volatility in that relative to bonds. But I'm just saying in this search for yield environment, certainly a 3.8% dividend is quite attractive. So I would expect this stock to rate well. If you go to moneyandmarkets.com in the top right-hand corner, you can click in the little search box and you'll see green zone ratings. If you type in a symbol like BTG and then click on the company name, you're going to see the green zone stock rating model that I developed. It covers 75 metrics. Those 75 metrics fall into one of 6 buckets. 3 of those buckets are price-based. So we're talking about momentum, size, and volatility. 3 of them are more fundamentals, which are value, quality, and growth. And all told, we give each stock that's rateable a score between 0 and 100. 100 is the highest and the most bullish. And we believe basically, or we don't believe, but we've done the research to show that any stock that scores 80 or higher has a good chance of beating the market by 3 times over the next 6 to 36 months. So let's see how BTG scores. BTG scores a very solid 75, which is in the bullish range. So basically from 60 to 80, a score of 60 to 80, the average returns are 2 times the market, and an 80 and above, the returns are 3 times the market. So let's look at the pros and cons of BTG. Technically, its technical factors are weaker than its fundamental factors. So we've got a momentum score of 20, a size score of 48, which just means it's a relatively large company, but not too large. It's just kind of a mid-cap miner, certainly not near the size of like a Barrick Gold or as far as volatility, it's a 30 out of 100. So the technicals aren't great on BTG, and that's largely because the stock's been in a pullback with a lot of the precious metals miners recently this year. So it's not going to earn a high momentum score right now. But if you're looking to buy a dip on fundamentals, BTG is a great way to go. It scores 94 out of 100 on value. I mentioned its price to earnings, 6 points up, and that's super cheap. 94 out of 100 on quality with a 36% net profit margin. That is a quality business, and growth is at 88 out of 100. Let's look at some of its growth metrics. Sales over the past year, a growth rate of 55%. Earnings per share over the past year, growth rate of 108%. And it's growing its dividend quite aggressively as well. So for me, I'm looking pretty favorably on BTG, B2 Gold Corporation. Again, I'm long-term bullish precious metals. All the metal miners that have survived the 2011 to 2020 period, when gold prices were declining and stuck in the gutter along that bottom, if they've survived, they have cut their costs and then they have built their operational efficiency so well that every bit of extra pricing power they have in the spot price of gold is basically going to go to their bottom line. So their profitability is going to explode higher as the price of gold goes up. And I think that's what we'll see here with BTG. I do have, let's see, 1, 2, 3, 4. I have 5 gold plays, gold and silver mining plays as far as stocks in the Green Zone Fortunes portfolio. They're not our top performers right now. As I mentioned, those are certainly been out of favor this year, but we aim to hold stocks in that portfolio from anywhere between 6 and 36 months. So we're not day trading. We're even going a little bit longer than swing trading. If we have the opportunity to lock in gains within 6 months, we will. But if we need to hold a position for anywhere to 2 to 3 years, we certainly will do that as well. I am recommending my subscribers be patient with gold and silver. I think that we will see this longer term bull run, but we just need to be patient. On this pullback, now is a great time to buy in. So thanks for that question. BTG for me is a buy. I'll spend less time on this other ticker, MTA, for a couple of reasons. First of all, it rates rather poorly on my green zone rating system. 11 out of 100, but that's largely because it seems to be missing a lot of data points. Again, my rating system looks at 75 individual metrics. And for companies who don't report basically data to be able to fill out all 75 of those metrics, either because of a special situation or certainly because when a company is new, if they just IPO'd in the last couple of years, they are not going to have the 3, 5, and 10-year growth rates, for example, that my metrics look at. So for me, MTA, which is a royalties play, does not have enough data to really be rated as far as my green zone system. I have looked at MTA briefly. It seems like they're focused rather than on mining the gold themselves, they're focused on buying royalties and earning yield on that. So that's certainly a valid way to make money in the precious metals market. To me, it's a little bit more speculative. I would need to dig into this company, this stock a little bit more in detail so that I can do the due diligence on it. I can't simply look at the numbers and give you a quick buy, sell, or hold recommendation. And it is much smaller with a market cap of just $366 million. So it's certainly going to be a lot more volatile and speculative. Just looking at the chart of MTA, it looks a little bit toppy. You've got something of a head and shoulders pattern. So technically it's looking a little bit weak. So I personally would steer clear of MTA unless you certainly have some, I won't call it inside information, but some very intimate information about their prospects and their business model. For me, it's just, it's kind of a pass. So I would much rather go with BTG, which is certainly a more sure bet as it looks. So thank you for these questions. I love analyzing individual stocks through my Green Zone 6-factor rating model, as well as through chart patterns. I am a CMT, that's a chartered market technician. So to me, price is king. I certainly look to buy stocks that are already in uptrends and that have momentum that's better than the market. Doing so both increases your odds of success and decreases your risk overall. So that's my methodology, whether I'm trading stocks for the medium and long term or whether I'm trading options. I have a number of options trading services as well. So thanks for joining me this week. We will welcome Matt Clark back next week, and we'll see if he wants to share where he was and what he was up to. But have a great 4th of July weekend and week, and I will see you next week. Take care.